Hi, I'm Dr. Heather Lutz, and this video is going to focus on the profit leverage effect. So, in this video, if I can click the right thing, basically, if you think about a company, there are two different ways that it can try and increase its overall profits. One way is to increase sales, the other way is to decrease cost. I like to think of them as they're two sides of a coin. They're both leading us to the same direction. This video is focusing on the profit leverage effect. So, this is a term that's used to describe or demonstrate that if we can decrease our costs, that's going to have a more significant impact on our bottom line profits than an equivalent increase in sales. So basically, what it's saying is that, like a $1 decrease in our costs, we immediately can put that in our pocket and keep it. But we're going to have to earn more than $1 in order to get that same impact in terms of keeping that dollar, increasing our profits by $1. All right. So the general concepts that we're going to use in terms of formulas for this are the profit margin and the return on assets. So the profit margin basically looks at how much profit the company makes for every dollar of revenue generated. You can see it's calculated by your earnings divided by sales. The other measure that we're going to use is return on assets. It's just another financial term that we often use in the purchasing or sourcing side of a company. And it's looking at how well a company uses its resources to make money. And that's going to be your earnings divided by your assets. So we're going to look at a simple example here to go through this profit leverage effect, practice calculating the profit margin and return on assets, as well as demonstrating the equivalent in terms of if we do some sort of cost reduction, how much sales would we have to earn to get the same effect. All right, so we're going to use this. A company called University Outfitters sells college apparel both online and in store. Last year, the company reported the following. So they had sales of 500,000. Their cost of goods sold was 300,000. Their pre-tax earnings was 50,000. And then if we look kind of the other side of our balance sheets there, the inventory is 80,000, and total assets are 200,000. So that's the information that we're going to use. You're going to see, I'm going to kind of solve this here in Excel. So all of that same information, I've taken the cheat sheet and put that in there already. All right. So the first thing that we're going to do is calculate like that current, what that company had for last year of their profit margin and return on assets. So if I bring that spreadsheet back up here, here's all of our information. So remember your profit margin was equal to your pre-tax earnings divided by your sales. So that's just going to be, in this case, 50,000 divided by 500,000, and we get zero point 0.1. I'm just going to change this to a percent here. So there's a 10% profit margin, and we'll just go out one decimal place. If we look at our return on asset, again, that was your pre-tax earnings divided by your total assets. Oops, wrong way there. And we get a value of 25%. All right, so again, we're just going to switch that here. All right, so that's kind of straightforward. We're just using our formulas here. Earnings divided by sales for profit margin, earnings divided by assets for your return on assets. Okay, so next the question is that we're going to assume that University Outfitters undertakes an initiative that reduces cost of goods sold and inventory by 10%. So we're going to see what that new profit margin and return on assets would be. So think of this as you sent out the people from purchasing. They did a great job and were able to negotiate overall 10% cost reductions. So we're going to say here, I'm going to do it as 10% reduction. So basically here, that's going to be our cost of goods sales is going to go down by 10%. So if we calculate that, it's $30,000. So what we're going to say is our sales are going to stay the same. Oops, let me get this here. Our the cost of goods sold is going to go down by 30,000, so that becomes 270,000. And basically what we're saying is your pre-tax earning is going to go up by 30,000. So this 30,000 that we were able to spend by not having to pay that to our suppliers for our materials, think about that. You're keeping it in your pocket. So our profits are going to go up. So in this case, if we do our profit margin, you can see it's increased to 16%. So again, it's just your pre-tax earnings divided by your sales. If we look at that 10% reduction in cost of goods sold, it also said it meant that there was going to be a 10% decrease in our value for inventory. So again, if we just do that simple math, what we're saying is our inventory is going to go down by $8,000. So our overall assets are also going to decrease by that $8,000. So remember, inventory is an asset on our books. We've already invested our money in that. So if the value of our inventory goes down, our overall total assets are also going to go down. So you can see here now, our return on assets actually has increased in this case. Okay, so that answers the first two questions that we had here. The last one is how much would sales have to increase by to have the same effect as that old pre-tax profit margin? So in this case, what we're saying is our old pre-tax profit margin was 10%. So to get that profit leverage effect, I'm just going to call that here. If I can spell, it's going to be we saved $30,000, or that's how much our profits went up. If we divide it by our pre-tax earnings of 10%, you can see the company would have had to increase their sales by 300,000. If everything else had stayed the same, that would have led us to that $30,000 in sales. So again, it's two sides of the coin. Either the company can undertake an initiative, try and reduce their costs by 10%, so $30,000, to see their pre-tax earnings go up by $30,000. On the other side, if they wanted to focus on increasing their sales, they would have to increase sales by 300,000 in order to see their pre-tax earnings go up by $30,000. So that's what the profit leverage effect is trying to show you. So again, there's two ways to increase the bottom line, to either reduce your costs or increase your sales. And what this profit leverage effect is trying to show you is that the company directly saves that money, that money goes right into our pockets. So we would have to earn more in terms of sales to have that same impact. So if you'd like more, I'll be recording more videos here trying to solve some of these types of supply chain problems. Also, just wanted to encourage, if you want a book about supply chain that tries to explain it in ways that relates it to your everyday life, go out and check out my textbooks. So have a good one.